on the screen right now as we start this week, and the closing trades are not looking healthy at all if you're a bull, because we are very close to the lowest point of the trading session, 23,600 on the index, a fall of almost 500 points on the Nifty at this point of time. Definite pressure on the Nifty Bank, 2.25% shaved off, 1,150 points off the highest point of the day as far as Bank Nifty is concerned. And even if you look at India Wix, that's managed to spike double digits. The last time I checked, it was up almost 13-14%, in fact 15% right now, and that's close to the level of 16. So there's acute nervousness which is there in the market, which is visible in VIX, which is visible in how the frontline indices are really performing. And then of course the mid cap and the small cap indices, they are too taking quite a bit of beating right now. So definitely a lot of pressure at this point of time, almost 3% cut coming in on the small cap and mid cap indices, and it is not looking pretty at all. And you can't really blame the globe for it, to be honest, because if you look at Asia this morning, yes, it was a bit mixed, but the European markets have by and large opened in the green, or they're likely to open in the green as we speak. Even the futures from US are suggesting a bit of a green. Nasdaq future is up 100 points right now. S&P future is up almost 0.3%. So no, it's not a global pressure which is coming our way. We are falling under our own weight. Key levels in 200-day moving averages have been broken today. Call it the impact of this new virus, HMPV, that the street is worried about. But we did speak with a whole host of experts, right from, of course, the money managers to the doctors to, of course, the officials coming in from the government. And everybody has to say the same thing, Aisha, that at this point of time, there's nothing to worry. It's a flu that has existed for almost 6 decades, and it is not a really fatal one and impacts only a limited, people. So that shouldn't be the worry point for the market, but clearly something is worrying them.
It is worrying. Two factors, one domestic as well as one global. The fact that, the Japanese finance minister has commented that they're going to be looking at increasing rates soon. So that sort of puts into jeopardy the yen carry trades once again. I don't know if we can bring up the Nikkei or not, because I was just observing that if you look at the Asian screen, Europe, of course, is completely undeterred. There's only FTSE, which is marginally in the red. But looking at Asia, it's only Japan, which has fallen as much as our markets, almost a 600-point knockoff. There's, of course, been Hong Kong as well, marginally soft and flattish with just a very marginal negative bias for China. So seems like a very Hong Kong specific problem. Yes, you can say whether that's going to sort of, impact the emerging market money flow or not, and within that, does it impact India as well? So that could be one of the factors as well. And of course, clearing up and cleaning up ahead of the earnings season, which officially kickstarts this week itself, with TCS due to report its numbers. 400-point of a knockoff is coming in on the Nifty as we speak right now, and the breadth as well is quite dismal. You've got a count of 177 to the declines within the F&O universe, with just about 23 names standing to the greens. There's, of course, Tata Steel, there's Trent, there's BPCL, Coal India. A lot of these commodity plays are the ones which are really caving off, somewhat smacking off a global linkage. Other than that, of course, there's Kotak Bank as well, after the COO as well as the CTO putting in their papers over the weekend. There are some of the consumption plays like a Trent, like I mentioned, Asian Paints as well, lower by about almost 3%. There's IndusInd Bank, HDFC Bank, which is at the session lows now, 2.5% lower. In fact, the Nifty Bank alone, reacting to some of these quarterly updates, is not really looking good at all. But let's welcome on board our chartists very quickly and figure out what they are making of the trade so far. Kunal, hi, afternoon. Firstly, your take on the markets and the way we are bleeding today.
Yeah, I think we are at a very critical stage for the indices, and it's very, very important to try and take note of how the technicals are placed for both the indices Nifty as well as for the Bank Nifty. So we look at the very important charts over the last 2 years for both these indices. This is the charts for Nifty 50 over the span of the last 2 years from 2023 specifically. When this major trend line, as you can see that for the index, we've managed to protect ourselves over the last 2 years or so. Every time there has been a correction closer to this trend line, we've found major support for the Nifty, and we've seen major bounce backs or turnaround for the indices in the historical context over the last 2 years. This is a very recent chart for the index, and we are still trying to safeguard. So at 23,200 levels, which we hit in the month of October and November, that was a point where we retested exactly that trend line support for the index. And again, we are now trying to just about retest the major support levels over here. So which means that we are at a very critical stage or at an edge for the index in terms of the long-term trend for the index, which we've been riding over the last 2 years. If we break below this level, the support for the index is at 23,500 levels on the spot basis, which means if on weekly closing we close below 23,500 mark, we could be looking at a major breach of this 2-year, 2.5-odd-year-old trend line for the index. Now the interesting part is what's happening to the bank nifty, because after after a span of almost 2 years, we've seen for the first time bank nifty breaking below its 200-day moving average. And again over here, the trend line support for the bank nifty is very important and critical. Over the last 3 months, broadly we've been into this 3,000 to 4,000 point range for the bank nifty, which means from the month of June, July 2024, we were stuck into a range of 49,500 as a support and 54,000 as a resistance broadly. Now we are again at a cusp of a major retest of this major support for both these indices, which means over the next couple of days, if there is a follow-through downtick for the indices, even by a margin of 0.5% to 1%, I think we could be challenging as well as breaking this major trendline support for the last 2.5 odd years.
Wow, that major trendline support is getting threatened to be broken, and what is getting threatened right now is 23,600. We did slip below that mark on an intraday basis. Let's see where we are at right now, just around that mark. So it's a tug of war clearly between the bulls and the bears. The bulls just trying to defend somehow the 23,600 level, but it's a 500-point shave off that we have seen from the index today, so not looking pretty on the screen at all. Daljit Singh Kohli also joins us right now. Daljit, what should one do? Keep the shopping list ready and start buying, or just stay away from the market because it's the falling knife right now?
Yeah, good afternoon. No, I don't think there is any panic or a situation where you have to stay out of the market. Of course, you cannot time the market and just be right exactly at the same point when it will be hit the bottom. Nobody can pick that bottom. You have to be ready with the purchasing list. I think a lot of stocks which you were earlier wanting to buy and some froth was getting built up. Valuations were getting out of whack. Those valuations will now come into some kind of reasonable zone. So depending upon the choice, which sectors you want to be, and there will be, I'm sure you'll get some opportunities. Till last week, we were all cribbing about that we want to buy, but we are not able to find something because valuations are too much. So now this is probably giving you that opportunity. I don't think this today's correction is kind of any change in the broad outlook of the Indian stock markets, or for long-term investment, there is anything which has structurally changed. It's just that there is, after so long of one way up move, there would be some reasons and some factors which will drive this kind of volatility in the market.
Kunal, just want to get your sense on some of the individual names, and I'm just mapping Trent right now, which has breached that 7K mark. I think the November lows were around 62, 6,300 thereabouts. Do you think it can get to that level, and should it, does it become a buy then?
So I don't believe that the stock should scale down as far as to that 6,200 levels, because the most important point which you look out for, that it's not been a flashy recovery for a trend. So the sell-off was very swift for the stock. But the way the stock moved from the 6,200 marks, towards the 7,000 plus levels, was more of a gradual and a very, labored up move for the stock price. That means that there were a lot of, stronger participants, which on the way up to this 700, 800 point rally for the stock price, I think, saw good participation. Now on the way down, you might not see, the weaker hands trying to exit the stock very quickly. And that could be one of the major reasons why the stock has already built in a buffer or a cushion of this 700, 800 points, as compared to many of the other, whether it's pairs or large cap names, which are now struggling to, break past below their previous swing lows. So I think I would probably believe, that in case if the stock happens to come by to even 6,700 or 6,500 mark, that would actually be a very good support point.
Okay, that's the take coming in on Trent right now. Naresh, what is your own sense on metals? Because they are the ones dragged most right now, led by, I guess, Tata Steel.
So overall, metals have been in a downtrend, specifically on the steel side much more, but even aluminum stocks have taken a drop right now. So for now, the trend is weak, and given that they're high beta stocks, you want to wait for a recovery in the indices before you can actually bet on metals. So for now, it's an avoid as such.
It's an avoid as far as the metals basket is concerned. But Daljit, what do you think is the problem area for the markets? Is it the fact that the FI outflows continue? Is it the fact the yen carry trade Aisha was pointing out to? Is it the nervousness around HMPV virus? Or is it purely about earnings and fundamentals? Or is it something technical?
I think most basic thing is the earnings part, which is actually after 3-4 years of very strong up move, we are seeing that moderating. And we expect that it will probably moderate for next year also. Many people were believing that probably Q3 and second half will be much better and earning recovery will happen fast. But in our understanding, probably that may not be the case. So market will have to adjust to this new reality. We have seen in last 2-3 years that 20%, 25% earning CAGR was coming in, which will probably not be the case now. One, it is because of the base effect. Second, we have already lost 6 months in this election and all these weather-related issues, etc., when labor was not available. So first half of the corporate India has already shown the numbers which were not good. Third quarter numbers are now going to start from this week onwards, and we are not getting very encouraging commentary. Some of the big companies have already shared their estimates today, and we have seen them, especially in financial services, not very encouraging numbers. Small bit of ray of hope has come from rural India, where we are seeing that rural consumption is picking up. But that is getting compensated or negated by the urban consumption, which is under the impact of inflation. So I think overall net impact would be that to expect 8 to 10% of earnings growth would be more reasonable. And that would mean that some kind of valuation derating will happen. Some expectations have to be mellowed down. So we could see this kind, and along with all this, we will have an impact of currency. We'll have some global uncertainties, new government coming in US, how things will pan out. That will also create some kind of uncertainty. So, but basic reason is, I think, earnings. That is what the crux is.
Yeah, gearing up for earnings, and you can definitely feel that heat on the Nifty Bank and financials overall as well. But Kunal, how much more of a fall do you think for HDFC Bank? Because this is in addition to Friday when the stock did get clobbered ahead of its quarterly updates.
Yeah, I think at least another 40-50 points is what I would expect for HDFC Bank further, because this is the second consecutive move where the stock has given a breakdown of its previous swing support. The first major support point. So when we look at the setup for the Bank Nifty, we were discussing that the Bank Nifty is fallen below its 200-day moving average. Now for HDFC Bank, that level is around 1650 mark, thereabouts for the stock on the spot levels. We are closer to 1710 for HDFC Bank, which means that even if over the next couple of days there is a further downtick for the indices or for the markets, HDFC Bank could probably drag down another 40-50 points at least to try and retest towards its long-term moving averages, which means that the sell-off or at least the pain point for the stock is not yet over. My belief is that the stock should, over the next maybe 2 or 3 trading sessions, or maybe over the next one to 2 weeks, I think should drag down another 3 to 4 percentage points.
Okay, point taken. That's the view coming in on HDFC Bank right now. In fact, time now to slip it a very short break. But as we do that, hear out what the experts and doctor have to say on the HMPV virus, because we spoke with a couple of doctors and both maintain the view that there's nothing to get worried about right now. It's a very usual type of virus at this point of time. Of course, need to be watchful of the same. Hear out the expert take on the same.
What we need to just do is just to have a cautious approach to see where and how the progress is happening. As of now, I don't see there is any alarm to be actually created, because these viruses are known to circulate during the winter months, and there is a small rise in the cases which we see all the time. The virus does cause symptoms which could be either upper respiratory tract symptoms and sometimes lower respiratory tract symptoms, can affect adults as well as children both. But I don't think there is any need to panic or any need to be concerned about it right now. I don't think there is any need to actually even think that we are going to go towards COVID right now. It is just a winter month virus which has seen a spurt in the cases.
This virus should be taken as a passing by infection. This virus spurts up in winters, and that's where we are. I feel no fear, no threat, and undoubtedly there should be not a blink of any, sitting back like COVID or acting like patients or humans that we were during the COVID time. I can almost assuredly tell you we are going nowhere close to COVID. This is not going to behave like COVID. There's also a distinct difference. COVID was a resurgence of a new virus. This is an old virus, which probably some mutation. We don't know if they're really mutated or not.
See, I don't think we should be pressing the panic button because HMPV is not a new virus. It is an existing virus. And the statement, the way report has come out that this is the first case of HMPV in India, which is not true because HMPV is an existing virus and certain percentage of people do get affected by this virus, and it is not something new. And the baby, the child that has got affected, has got no travel history, and they're all local people. They're not coming from China or Malaysia or some other country. So I do not think there's any connection to that. China's outbreak is, they are saying, is a new variant of HMPV.
Back with closing trades right here on ET Now, and the heat in the market definitely is being felt, and we've now swiftly, dumped down all the way to that 23,500 level. And to think of it, just last week we had closed in above that 24,100 print. It's a good 500-point fall that you're seeing from the peak of the day, even though we started off a lot more tempered. Pretty much across the sector weakness, though only you can see IT is the only dots of green in FI TCS Wipro, but that too only on a relative basis, and Nykaa, of course, reacting to its quarterly updates. Other than that, power, infrastructure, banks, real estate, oil and gas, metals, all these sectors are getting clobbered as we speak right now. But Daljit, where is it that you feel that there could be some more pain in store when it comes to the earnings season? Where could we still see further EPS downgrades?
So it is across the sectors, mainly the stocks which have seen a very high valuation, where we will see maximum pain because you are already building in high growth. No, most of these PSUs, railways, defense, all these fat stocks, power stocks, pretty much the stock sectors that were running for last 2-3 years, you've seen that actually you've built in 30-40% growth regularly. Now, once that expectation changes, then this valuation will look very big.
Okay, point taken. So that's the take coming in. Separately, it's Devyani International up 6%. You have Rainbow Children's doing quite well. Godrej Consumer is sitting with a gain of around 2.25%, and then some of the select pharma names. In fact, Nykaa was doing quite okay at the start of the trading session on account of that Q3 update. Now it's coming a bit under pressure right now, and of course ITC is that reaction or the adjustment happening to the hotels business. Naresh, what's the sense on the charts of Devyani International and even Godrej Consumer for that matter?
So if you look at Devyani International, you've seen a good take in the sector as such in terms of recovery. Jubilant Foods leading the pack. But little longer term, if you look at Devyani, there have been multiple attempts around 210 to 220 for the last almost 2 years. And the stock has done nothing beyond that in terms of a breakout. Every time the stock has shown a lot of momentum and again fizzled off. So for now, I would wait it out. The risk reward is not great. And in terms of Godrej Consumer, the stock has corrected from 1500, 1550 all the way down to 1050. We are making a bounce back, but it should again face a resistance around the 1200 mark. So at current levels, still not a buy.
Did to put in a buy call on any of these names right now, be it banks, metals, or even some of the, consumption plays?
So yeah, maybe consumption, maybe if you select auto stocks, that's where I would probably want to focus on, because there could be a point where, these stocks may look very attractive in terms of risk reward. So for example, from the auto pack, Bajaj Auto is something which looks attractive. Tata Motors, I think closer to that 740-50 mark. if the stock happens to come back or retest that level, that's very strong retracement support for Tata Motors. So these are two attractive contrarian zones where traders could look at start entering into the stock, especially for someone who's maybe booked out earlier and looking to rebuy the stock from a long-term play. I also believe that Eicher Motors is the other stock which has confirmed a breakout, and after almost 9 months or 12 months of the stock going into almost like a 400 to 500 pointer consolidation from 4600 to 5200 levels. So that I believe could be another interesting name to watch out for, because I believe that with every move from sectors, there are few stocks which emerge as fresh leaders with every market move, and then there are few names which becomes very attractive from a risk reward play. So I think from the latter category, you might probably have the likes of Tata Motors, which could be very good risk reward plays, and even Bajaj Auto in that sense, and probably you might have Eicher Motors, which could emerge as fresh leaders from the auto pack.
Daljit, what's the sense on the PSU banking names? I mean, that's the worst performing sector today with a cut of almost 4%. I mean, individual names like Union Bank, Bank of Baroda might be reacting to the provisional updates. But are there any PSU banking names that you would perhaps take a bet on?
Not really. As of now, we are not looking at any of these banks, neither PSU nor actually private. Only in the financial services, we have some housing finance NBFCs in our portfolio and some power finance companies, mainly because they are in the niche areas and there the problem of quality of asset is not an issue and the growth is also there. But with these PSU banks, that the names that you took, I think they are going through a little bit of patchy phase, which will continue for some more time. So we'll wait for the entry there.
Any buys from the PSU banking pack? Naresh, the question is for you. Any buy calls from the PSU banking lot?
So that would be State Bank of India itself. The stock has gone sideways for the last almost 10 months. Available at the 770 prices where it had first reached in Feb of 24. So the stock has gone nowhere. On the election day, June lows were around 750 to 770. So good enough consolidation done. 750, 770 is a good band to accumulate for the medium to long term. And the stock had not seen a parabolic move like some of the smaller PSU banks. So I would expect going forward, SBI to be a best one in the PSU bank basket.
SBI is still the favorite within PSBs. But the one stock which has been in focus has been ITC on account of the hotel demerger. Here's Sharad joining in to tell us all you need to know about this demerger taking place and what gets remained in ITC. Sharad?
Well, yes, ITC Hotels is in focus, and of course today itself the entire ITC stock is trading ex the hotel business. Now, of course, calculating the fair value, important things to know, it's debt free. There would be a cash transfer of almost 1500 crore rupees, and if you are holding 10 shares of ITC, you will get 1 share of ITC Hotels. Now, brokerages are expecting that the pricing could range between 113 to 300 rupees per share. Now, also remember that British American Tobacco is expected to hold roughly 15% stake in this new demerged entity. Now, calculating the fair value, the difference coming in between the January 3rd close and January 6th opening would be there. And interestingly, this would be excluded from the indices for 3 business days after listing, provided there are no circuit breakers. That's an important point. Now, of course, there might be a delay in exclusion if the stock starts hitting the circuit levels. Now, of course, the listing is expected to happen over the next 1.5 odd months by the mid-February. But now let's also look at its peer, Indian Hotels, and of course the growth triggers coming in the 3 segments in the non-F&B business, Taj Sats category, and also they expected to 2x their revenues by 2030 to a consolidated basis of roughly 15,000 crore rupees. But if we take overall the recent listings post the demerger, the entire time taken for the record date, Jio Financial, it took almost 33 days, Piramal Pharma, it was 45 days, and NMDC Steel was 4 months. Of course, comparing IHCL and ITC Hotels is also a very important point which I'd like to point out. The rooms, if you look at it, roughly you could say 13,000 rooms are there when it comes to the ITC Hotels. Almost you could say double when it comes to Indian Hotels. Revenue per room, the RevPAR, that's an important operational parameter which we check it for hotels. It's almost even Stevens, but if you look at the occupancy, that's on the higher side when it comes to the Indian hotels. Now let's also look at the market cap expectations and the margin. That's where we derive the valuations also. And if you look at it, the market cap, it's largely double if you look at the range which have been given by analysts, and the margins is on the favorable side of ITC hotels. But do remember, Indian hotels also is having some budget hotels also in their category, and that is why there might be a reason that the margins might be slightly lower when it comes to ITC hotels. And these are all the consolidated numbers as per FY24.
Much for that, Sharad. But let's take it across to Snehi now to get a sense as to what will be in store for ITC after the demerger, especially with respect to BAT stake and the other triggers forward. Snehi.
Well, absolutely. Now it merits a look on what is going to remain with ITC and what happens to ITC after the hotels business demerger, now that the record date is also here. ITC X hotels price discovery happened at 459 rupees per share today, which was roughly lower by 22 rupees. This is what the traders also had previously broadly estimated that would happen to the price of the stock today. Now, how does ITC look today in terms of financials on the back of this demerger, post the demerger? If you take a look at the financials of ITC, the hotels business contributed 3,104 crores recently to the overall revenue, which made up 4% revenue of ITC. So we can expect a cut of roughly 3,100 crore rupees when it comes to the revenue part. Similarly, for PAT, ITC hotels made up 3% of ITC Limited's overall PAT, which is roughly an amount of 765 crores. So from the overall PAT, we can expect a reduction of roughly 765 crore rupees in the next quarterly earnings as well. Now, how will the SOTP, the sum of the parts, shape up when it comes to ITC Limited? Remember, the cigarettes business made up 62% of the overall ITC Limited business, which will now come up to 64%. FMCG will contribute 18%. Paper boards, which is a strong segment for Q3, will contribute 5%. Agri will also come in at 5%, and IT and cash respectively at 4% and 4%, which will make up the total SOTP pie for ITC Limited post the demerger. Now, let's talk about what happens to the BAT stake. The British American Tobacco, they had already earlier stated that they plan to sell roughly 25% stake in ITC. Now, in correspondence to this 25% stake that they want to sell in ITC and ITC's 40% stake that they hold in ITC hotels, this will roughly translate to a 15% stake sale in ITC hotels from BAT. This is what we can expect to happen going ahead as well. Largely, what are some key triggers for ITC going ahead? The first and the biggest one is going to be the prospective GST tax. The chatter has been about the 35% tax bracket. It's not been discussed in the recent GST meeting, but could be on the agenda in the next one. So, whether this 35% tax bracket goes through for cigarettes is going to be important to watch out for. Paper business, which contributes roughly 5% to the overall SOTP. Q3 is largely expected to be a solid quarter for the paper business, so the numbers on this front will be important to watch out for. And lastly, also watch out for the FMCG business, because overall pure play FMCG players have been complaining about a slowdown in urban demand on the back of inflation, raw material inflation remaining sticky. So these are going to be some important triggers to watch out for. But well, yes, this is what ITC Limited will look like post the demerger of ITC hotels.
Right. Okay. We'll leave it at that. Snehi, thanks for analyzing ITC's demerger and what's the next step here. But Daljit, good to have you on the show. Thanks for taking the time. We're going to take a very quick break, continue tracking markets. On the other side, still lower, pretty much at the session lows, a good 367-point knockoff on the Nifty futures alone.
Well, a bit of a recovery from the lows of the trading session, 100-point that is, from the lows, but still very much in the red with a cut of almost 350 points on the Nifty, 1,000-point on the Bank Nifty. Tata Steel is one of your top losers, Coal India, BPCL, NTPC. So clearly the public sector entities, whether from the frontline index or the banking index, they are the ones which are causing quite a bit of pressure in the markets right now. Chakri Lokpriya also joins us on the show right now. Chakri, given all of this health scare and whatnot, and the fact that pharma has been something which has got a bit of a tailwind in any case, whether it's the CDMO players, whether it's diagnostic or hospital companies, do you think this is the space to bet on right now, healthcare and pharmaceuticals?
Healthcare and pharmaceuticals, healthcare, whether it's the domestic hospitals chain, are probably kind of better positioned because, the revenue growth will kind of remain intact. They'll grow faster than that of the Nifty. Their valuations are also quite high. So, at best, you could expect maybe an 8 to 10% return for the year. On the other hand, the pharmaceutical companies, the export-facing ones, maybe Glenmark, maybe Dr. Reddy, they could actually have a slightly higher earnings growth because the globe is recovering, and therefore, and they also have product launches, so therefore maybe Dr. Reddy's and Glenmark.
Reddy's and Glenmark, those are the stocks that Chakri is liking. But Chakri, what is it that you would be compelled to sell given that earnings are fast approaching and given the color that we've got at least from the Q3 update so far?
Yeah, I think, actually, I think pretty much everything in cyclical as well as, staples, both are seeing earnings downgrades. I think we'll be lucky if Nifty ends up, with a 5% to 6-7% earnings growth for the next 12 months. So if that is the case, then the Nifty the Nifty returns are unlikely to be much better than that. And so if anything, it's, I think, within industrials, the earnings growth is likely to be faster. And of course, the export-facing ones, which is IT and Pharma, will grow much faster than that of the Nifty. And there's valuation comfort there. So what still it is, looking, really sifting through large amounts of rubble and nothing significant out there.
Nothing significant out there, at least at this point of time. But clearly Tata Motors, the sales data was out for UK, was on the weaker side. That stock has been something that we have been pointing out too. And the fact that Punch has become the largest selling car in the country and overtaken Maruti is definitely something which has become quite a bit of talking point over the weekend. Within autos, how are you placing yourself, Chakri, especially in the passenger vehicle segment?
Within the passenger vehicles, if you look at the two-wheelers, the revenue growth rate has slowed down. On the other hand, maybe the tractors is picking up. It's not passenger vehicles, but that's picking up a little bit. On the other hand, the Marutis and the Hyundais are still facing the pressure. So against that backdrop, I doubt that any significant returns, because we're unlikely to see any earnings upgrades. Let alone stable earnings. So against that as a backdrop, until interest rates are cut, I think unlikely to see anything meaningful in autos.
Nothing meaningful in autos is what Chakri is anticipating. Kunal, of course, was talking about as to how Eicher definitely could be a buy after the recent correction. And Kunal, which was the other one? M&M?
Yeah, M&M as well as Bajaj Auto.
Oh, M&M and Bajaj Auto. Okay, I don't know why I recalled Eicher. Okay, in the meantime, let's just revisit some of the other drag points. And clearly, it's across the board. Financials. Union Bank, by the way, is now down almost 8%. ITC, of course, is that demerger adjustment that you're seeing. There's also the Adani group of names which are, facing the heat quite a fair bit. BEL, which was sort of pegged to be the stock for this year, that's also down about almost 3.5% or so. And consumption, Asian Paints currently lower, Trent as well is down. And that can be said about a lot of these auto names, of course, in today's trading session. But Chakri, other than the spaces that we've talked about, just wanted to get your sense in on pure play staples as to when is it that you foresee any recovery at all, or do you think going by what Dabur's commentary has been, do you sense that staples would continue to be under pressure even in Q3?
You're right. I think staples are likely to be under pressure even in Q3, whether it's Dabur or you look at Marico. Again, the top line is okay. It's probably growing at about 10-12%, but bottom line is growing only at about 5 to 6%. And along the way, they're losing a lot of margin, and because they need to sustain on a high level of ad spend, they don't have pricing power, and all that is hurting the profit margin. And for FMCG as a sector, which already trades at very high valuations, if you don't have the protection of profit margins, then the valuations will drift lower. So I think the stocks are likely to tread water at best or even drift lower.
Okay, so that's a take coming in on some of these consumption names as well. Just taking stock of some of the big movers at this point of time, and just want to put the spotlight as to what's happening with Ease My Trip as well, because that stock was in focus earlier in the day on account of that promoter clarification coming in. For now, PTC Industries is the one which is doing well. Devyani International, Equitas Small Finance Bank, and then Ajanta Pharma, RBL Bank. These are some of the names in the green, and Nykaa too is in the green, though materially off the highest point of the day. On the losing side, HEG is under pressure. You do have Intellect Design, JM Financial, as well as Inox Wind and IREDA, which is in the red right now. Naresh, comment on the charts of some of these counters which are trading at high volumes. PTC India in this market is actually sitting at all-time high levels. Even, Info Edge for that matter is right now down 1.8%, but at the start of the day, that was also at all-time high.
So PTC Industries is something which has gone up massively over the last 2 years. So the stock has gone up from, say, closer to 2,000 rupees back in 2021-22 to almost 15,000 rupees. Tough to take a call here, not a stock which has seen a lot of institutional participation as of now. So that would be an avoid. Info Edge on the other end is interesting. The stock has been a classical higher top, higher bottom formation. It's been a slow mover compared to the other names in the new age companies, given this is old one. But the trend is still strong. 8,500 is a trading stop loss, still remains a buy on dips to 86, 8,800.
Okay, point taken. So that's the view coming in on a couple of these counters. But let's get you some fundamental opinion also coming in from Hiren Ved. We talked about a whole host of sectors and issues. Listen into some of the key ones. Okay, we will try and pull up that soundbite because the discussion was very interesting around a lot of EMS companies, which has become a long-term theme. So Dixon is something which has been in his portfolio for a long time. Trent is something that they're focusing on. The upper end of consumption is something that they have been, quite positive on. Hear out his view.
The market's been in a corrective consolidation phase for a while now, and it might continue for some time. But I think the biggest catalyst to my mind more than anything else could be the result season, frankly. Because once there is confidence that earnings can come back and growth can come back in Q4, I think the markets can get back to the races. At least what I get to understand from the Q3 updates is that from a very challenging situation, you're getting to a little bit less challenging situation, right? So it's all about incremental improvement on a quarter-on-quarter basis. I think structurally still the lower end of the consumption trend is still quite soft. We may see improvement from absolute bottoms. And I think the stocks are also reflecting that because the stocks have not done anything for a long period of time. So sometimes more than the performance, it's actually what you deliver versus consensus expectations. So if the expectations are so low and you do slightly better, the stocks can do better, right? So I think again, like in financials, I think in the consumption basket, we still believe that the more discretionary, higher ticket consumption will probably do better because there the consumer's balance sheet has generally been very healthy, right? I mean, his stock portfolio is up, his gold is up, real estate is up. And I think that that's where the momentum is. So whether it is premium real estate or otherwise, if you want to do lower end consumption, then I think you are better off buying the platforms because they are aggregating demand across all segments and growing faster than, let's say, an individual FMCG company, right? I mean, a Marico or a Lever is still struggling to do single digit growth. The platforms are still delivering you 20, 25, 30% growth. And I think that's where the story is. I think capital markets is a far better place to be in on a structural basis, right? There could always be a few stocks that can be an exception to the rule, but I think non-lending financials is where I think the action is going to be. So wealth managers, brokers, asset managers, I think that's where money is going to be made on a structural basis because it's very clear, right? I mean, if the depositor is moving from not putting deposits to doing SIPs, you better be on that side of the balance sheet. I think by and large, financials is still, more constrained by credit growth, right? The problem with the banks, as you can see from the HDFC update, is that while they've done very well on deposits, but they'd had to sacrifice advance growth, right? So I think, and that's the problem, that adjustment still continues where, everybody needs to shore up their deposit growth and moderate their advances growth. And we have seen a spike in unsecured lending. Obviously, MFI is at the extreme corner of that. But I think unsecured lending has, we've seen a little bit of a spike. So I think, I mean, this sector, the lending sector to me is likely to be, as a whole, very middling in its performance. There may be some standout performers. And I think Bajaj finally seems to be coming out of that kind of middling performance where, there was a lot of confidence that came back during the Bajaj Day that they did a couple of weeks back. And I think when the rest of the big banks are thinking of compounding or growing at 12 to 14 or 15, 16%, if Bajaj can grow at 25%, that's a great differential growth rate, right? So I think you'll have to pick and choose, but on the whole, I'm not very excited about lending as a space.
Not excited about lending. Stay with the capital markets theme. That's the view coming in from Hiren Ved from Alchemy Capital. Let's just take in some BTST trades. We're headed in for an over 400-point decline in the Nifty on a closing basis. Kunal, what's your list?
So I'll go with the band Bajaj Finance, expecting the stock to still remain a lot more sturdy than what it is today. Buy with a target of 7,600. Stop loss could be kept at 7,200. And Brahman Enterprise is something which is given a breakdown. The stock has broken below its previous supports of 1100, 1080. So we recommend a sell with a target of 1020. Stop loss at 1075.
Okay, that's a sell on Piramal Enterprises, a buy on Bajaj Finance. Naresh, what's your list?
So first is the one Nykaa. The stock has been trying to hold on to the gains today. Stop loss at 169, target price of 180. Second is a sell on MCX, a classical double top in a breakdown here. Stop loss at 58.70, target price of 5700.
Okay, that's the take coming in. Some of the BTST trades going in that way, just clocking down to the market close, and that's definitely a bleak picture. I just want to mark what the global markets as well are up to. Japan, of course, closed in with a near about 600-point decline. Other than that, I don't see much of weakness across the global screen. Definitely not for a Hong Kong or for a Shanghai or for that matter, the way the European markets as well have panned out. In fact, some of them are mighty up in the green. Look at a CAC that's holding up nearly 1% right now. You've got DAX up almost 90 odd points. And it's a decent move even for the FTSE MIB as well as the Stock 600 as well. Chakri, do you believe that aside of course, earnings nervousness, this could also sort of smack off what's happening with Japan, given that there have been some comments coming in from the finance minister that they may be looking at upping interest rates, and that sort of is bringing about some panic on yen carry trades once again?
You're right. Yen carry trades does kind of impact a little bit. But to compound that, I think we have a domestic issue in India with earnings slowing down. In 2024, if you take the calendar returns, if you're off the Nifty, post-tax is about 4%. So for a 4% port, and that kind of largely explains why the FIIs have sold off, because if the US markets return 22% in calendar 24 versus the Nifty at a 4%. So here, higher taxes, capital gains, etc., all of them have played a role. So what will negate all that is a lower interest rates, hopefully so, and higher earnings growth.
Point taken. So that's something that we need to watch out for. Last 10 minutes of the trading session, and bulls today will definitely be thanking that in 10 minutes the markets will end, because it was looking very, very wobbly. India VIX had shot up quite materially, and we are again below the mark of 23,600. What does it tell you about the markets, Kunal? Are we headed much lower on the index? 23,600 has been broken on an intraday basis, and not just once, twice or thrice we have gone below that mark now.
Yeah, we are retesting, a critical support point time and again over the last 2 months. So I think from November, lows of 23,200, then we made a high, then we made a low which was slightly higher around 23,600 mark, and today we are retesting the 23,600 for the index. So yes, the market structure over the last 2.5 odd months indicates that the indices are still struggling, and there is a lot of weakness into the into the index trends. But then what's also concerning for the markets this time around is that the strongest sector which was there in the recent past, which is Bank Nifty or the banking index, that's the one which is leading the the index to a downtrend. So I think that could be a major concerning point, because we've seen historically that when bank index or the bank nifty starts to show signs of a major a reversal or a downtrend, that has a huge impact on the benchmark indices. And post that, when bank nifty shows signs of weakness, it becomes very difficult for the benchmark nifty to try and gather its or regain its momentum and try and come back into any kind of a major recovery mode. So I think the major impact for the market trend would probably rely on how the bank nifty behaves. And looking at the structure so far, we still believe that the banking stocks and the large cap private sector banking names, there is still room for many of these large cap private sector banking stocks to head on the lower side by a margin of another 3 to 5%. So that should trickle to the benchmark indices also over the next few weeks.
3 to 5% downside seen some of the banking names. Naresh, would you concur with the view? And if yes, which are the stocks from the banking pack that you would think will come first on the buying list after the correction?
So I would wait out for a couple of days more, because we've been in this market which has been choppy in terms of every time we've felt like a breakout, whether it was at 24,800, 24,000, we flopped. Now on the downside also, we've seen this choppiness. So I'll wait for a couple of days. If it sustains below 49,500, that's the point of time I'll accept that the breakdown has taken place on Bank Nifty. For now, wait and watch.
Okay, just want to see what some of these diagnostic names are up to, because, along with our HMPV scare, there's only the diagnostic names which are actually holding out. While, of course, it's just been 2 official cases. We understand there could be a third one perhaps in Gujarat as well. But Metropolis, their quarterly update as well was strong. They're looking at a revenue uptick of about almost 11%. The B2C revenues grew approximately about a 15% on a year-on-year basis. Other than that, of course, Dr. Lal, Thyrocare, these are all names which are also holding out. Chakri, do you sense that diagnostics perhaps, given this entire scare around HMPV, could play out to be a tactical trade at best?
Hopefully not, because the rest of the market will fall if it turns out to be a scare. And but having said that, I think the valuation Metropolis has fallen quite a lot. So I think as a positional trade, I think there is sufficient room. But again, the rest of the world is not panicking on this flu scare. It's only India that's showing most of the downtick.
Yeah, I think we are the nervous lot today, and clearly very, very nervous for the market at this point of time. Nothing is holding on to gains. Most of them have actually given up, and a lot of reds on the screen today, right from an ITC to an HEG to what's happening to Garden Reach and other names as well. What do you make of real estate right now, Chakri? Because again, there are a bit of a divergent view coming in. If you go by the anecdotes, there aren't many buyers, and there are people perhaps out there to sell some of their properties. But if you look at the sales figures that come by or the inventory data, that does point that there is still more room available on the upside. What's your sense as to where the real estate pack is headed?
Good question, because if you look at the real estate companies, it largely now depends upon the kind of inventory that each company is holding. Now, if you look at DLF, their year-over-year sales is very strong. And, and that business momentum will carry into, at least for the next quarters. So that looks strong to buy. On the other hand, if you look at a Prestige, its volume growth is less than a couple of %. And therefore, you don't have that kind of visibility that you have in a DLF. So I think in the case of real estate, there are pockets which are holding up, maybe a DLF, but not some of the ones like Shobha, where they've run up a lot. Now the inventory is kind of catching up.
Well, you are definitely seeing quite a bit of crack across the realty segments today, like is the case with the rest of the market too. But Kunal, if the weakness in the market were to continue, do you sense that once again it will be pharma to the rescue along with diagnostics like we just marked out?
Yeah, I think there could be a possibility that pharma could stand to outperform. I also believe that there could be a potential revival for many of the underperforming names. Now, there are 4 sectors which in the last 3 or 4 days has shown signs of recovery. The auto stocks, the auto sector is one of them. You've seen FMCG stocks, many of these FMCG stocks, or rather the FMCG index is coming closer to its long-term moving average after trading, with a margin of almost 10% downside, closer to this long-term moving average. Then you've seen recovery into the energy index and the oil and gas, space over the last 3 or 4 days, which means that there could be a potential, chance that many of these underperforming sectors in the previous leg of the market trend, that's over the last 3.5 odd months from the September highs of 26,200 approximately. I think we would probably expect that many of these, few of these underperforming sectors could also try and make a comeback. Now it's very difficult to gauge which stocks, but then what we look out for in terms of pattern is relative strength or a resilience for these stocks. Now, for example, on a day like today when the indices are down 1.5%, Bank Nifty is down 2% plus, if you see stocks within the respective sectors trading with a positive bias or even a flattish bias, that's generally an indication or a first indication that these stocks have inherent strength amongst themselves. And whenever the market gets back into any kind of a bounce back or a short covering mode, these are the names which typically tends to bounce back first. So we look out for those initial signs popping up into these kind of sectors. But I believe that other than pharma index, you might probably have maybe one or two of the underperforming sectors making a strong revival or case of strong comeback.
Okay, so pharma is one of those spaces where perhaps people can hide. Before we toss it to Snehi for the market close, Chakri, a quick word on the IT pack. We'll start getting the earnings this week, and today as well there were 4 or 5 upgrades that came in on the IT sector, individual names there. What's your sense and what stands out to you within IT?
Clearly that's where the greatest strength is. Infosys will probably report, you'll see numbers as well. So they'll probably beat expectations and their growth will be far higher than that of the Nifty. So, I'd buy both across the board, IT companies, large and mid cap, whether it's an TCS or an Infosys or whether it's a Cyient, KPIT, those kind of companies, ERD companies, all are likely to show stronger numbers, at least stronger outlook, not stronger numbers, but stronger outlook.
That's the word coming in from Chakri on what's looking good in that space right now. But on that note, let's wrap it up on this trading session for today. It's been a one-way downfall coming in for the markets. The new variant has got everybody scared, has got the market spooked as well, even though experts have told us that it's nothing new to worry about. But still the street is taking it with a slight bit of a cautionary stance. 1.5% cut coming in on a today basis on the Nifty. A roughly 370 point cut coming in. We had slipped below the 23,600 level. We've managed to cross that once again. So at least some bit of a recovery is what we've seen from the day's lowest point. But well, we have dropped quite significantly from the day's highest point of 24,090 odd levels. So well, yes, that cut continues to be there on the Nifty. Sensex in tandem, a 1.5% cut coming in on the Sensex as well. 78,000 thereabouts is where we are, and looking difficult to hold on to those levels also right now. Broader markets have seen deeper gashes coming in today, 2.5%, roughly 3% lower is where the Nifty mid-cap index is. Small cap is the one that is underperforming its peer indices. 3.2% lower is where the small cap index is. What also merits a mention today is the India VIX and the way it has shot up today and the kind of volatility that we've seen in the market today. We crossed the 15 level and 15.6 is where we are at, a 15% uptick coming in on the India VIX today. Advanced decline ratio steeply in the favor of the declines today. No surprise over there. Let's talk about some stocks that have managed to hold on to the green today from the Nifty 50 pack. Only a handful of stocks. You have the likes of Apollo Hospitals, Tata Consumer, Titan and HCL Tech, as well as ICICI Bank that have managed to hold on to the green. Rest, all the constituents of the Nifty 50 have closed in the red, dragged most by Tata Steel, Trend, BPCL, Coal India, NTPC. If you take a look at some sectoral gainers and losers in today's trade, then IT was the one that managed to hold on to the green for most part of the trading day, but nonetheless gave in to the selling pressure. But Nifty IT is your least sectoral loser today, the biggest being Nifty PSU Banks, a roughly 4% cut coming in just on an intraday basis on the PSU Banks, led down by Union Bank, a weak set of updates coming in, Bank of Baroda, Maharashtra Bank, IOB, Bank of India, PNB, all of these have been deeply in the red today with cuts of more than 4% each coming in on all of these banks today. Followed by that, Nifty Realty was in the red, energy, metal, auto, banks, FMCG, pharma. That's the pecking order of the top sectoral losers in today's trade. Lots of updates that came in, lots of brokerage notes. The entire metal pack was in focus on the back of Jeffries note coming in. Realty in focus on the back of that note coming in on Oberoi and DLF. Even though it was positive, Realty is your second biggest loser in today's trade. All in all, it's been a massive cut coming in for our markets today. We've had a word of caution coming in from experts saying that this virus is nothing new to worry about. So let's see if the street is able to turn the sentiment on the positive side, and if tomorrow holds some day of gains for us. But nonetheless, this is how we are wrapping up today. A more than 1.5% cut coming in on the Nifty just on an intraday basis.